The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Podcast with Alasdair MacLeod, keeping you up to date with expert opinion on precious metals and the markets.
Hello, this is Alasdair MacLeod of Gold Money, and with me on the line from, I think it's home actually in the southeast of England, I have John Butler, who is the author of the Amphora Report, and also wrote a very interesting book, The Golden Revolution. Welcome to the podcast, John.
Thank you very much, Alasdair.
It's very much my pleasure. Now, tell us a little bit about the book you wrote, The Golden Revolution. It might help our listeners get, if you like, a handle on your approach to the whole subject of precious metals.
Right. Well, I wrote the book because I felt it was a book that needed to be written. I had read many books describing the monetary problems that have built up through the years and that have contributed to the global financial crisis in 2008, and of course are also continuing to contribute to very subpar economic growth in many parts of the world. So those books had already been written. There had also been many books written about how it would be desirable to go back to some form of gold-backed money, some form of gold standard. So those books had also been written. But the book that hadn't been written, it seemed to me, was the book that actually attempted to take a look at the current state of affairs in the major economies and the developing economies around the world, and to connect a few dots, apply some historical lessons, apply a little bit of game theory, and actually try to demonstrate how we get from here to there. What are the plausible scenarios that lead us back to a gold standard? And in the book, I discuss several of those plausible scenarios, and then go on to discussing the financial and economic implications thereof.
Right. So actually, it must have been quite a difficult book to write because it's a rapidly moving target the whole time.
It is, and one of the challenges in writing the book was to try and leap sufficiently far ahead into the future so that the book would remain relevant for a sustained period of time. So the book is not about what happens tomorrow, although that said it could, in theory, happen tomorrow. The book is much more about how I see things unfolding over the next 3 to 5 years.
Right. Oh, well, that's great. And I'm sure that a search through Amazon, for those that are interested, will find it.
Oh, yes, it's there.
It's a particularly interesting subject at the moment, obviously, with the volatility in the markets. Gold, as we speak this morning, is way down. This is Thursday, the 16th. They've had another bash at it. And yet, on the other hand, we have figures from the World Gold Council this morning that shows that in the first quarter of 2013, gold demand, and we're sort of adding up things like jewelry, coins and bars, technical, central banks and so on, comes out to about 1,140 tons. ETF sales are a minus 177. So we're ending up at a sort of annualized gross demand of over 4,500 tons, net of ETF sales about 3,850. Yet that doesn't include the massive leap in demand, which I want to come on to in a moment, in the second quarter, because we had the knockdown in April, and surprise, surprise, suddenly all sorts of buyers came out of the woodwork all over the world for the physical. So the World Gold Council figures, even if they were accurate for the first quarter, are now no longer relevant. So we've got a very volatile situation in the gold market. But do you have any sort of view as to how a knockdown in the price of gold, when we've got quite a lot of systemic risk and government deficits are extraordinarily high and they're printing money at a huge rate, is there any justifiable reason that you can think of that the price of gold should have gone down?
I think fundamentally no, but I respect financial markets and commodities markets for what they are. And there are animal spirits always present, there are speculators always present, and there are weak hands being played and there are strong hands being played. And based on the evidence that I have seen about who appears to be selling and who appears to be buying, this just seems a classic case to me of a shakeout of relatively weak hands in gold And so gold is moving from relatively weak hands to somewhat stronger hands. It's also moving from west to east. And I think this is an important way to understand what is happening with ETF holdings, for example, vis-a-vis actual physical demand. It's not lost on Asians, given their historical experience and even their more recent historical experience of going through the credit crisis, which they, of course, believe originated in the West due to very poor financial regulation and incentives and corrupt practices and whatever else. They don't. The Asians don't trust the West anymore, and so when they choose to invest in gold, they're not going to buy some ETF which has been created and has a custodian, which is a major Western financial institution. They're not going to touch it. So you may be getting Western investors reducing gold holdings because they see the trend in the stock market and they prefer to get exposed to risky assets because those trends are in favor at the moment for a variety of reasons that we'll probably discuss later in this podcast. But within the gold market specifically, when the Western investors sell out of these products and the Asian investors see a lower price for gold, it's the physical they want. And so this is how I understand what's currently happening. And if you let this process continue for a while and the physical supply situation tightens up a bit, which it appears to be doing, that should put a floor under the price and get us back into an uptrend if indeed the fundamental picture remains supportive for gold going forward, which I strongly believe it will.
Yeah. Now, that's interesting. I mean, just sticking with gold for a moment before we look at the broader sort of global economic scene, it seems to me that we've ended up with a situation where the paper market, as always, is dictating the price in the short term. The physical bullion has been bought out, if you like, from underneath the bullion banks. And now there seems to be, the way it's being controlled is not through price, but by rationing almost. We've seen huge demand in China, yet if you look at the Shanghai Gold Exchange's delivery figures, I mean, that's collapsed from, I think in March we were close to 300 tons, 297 tons. April was down a bit on that, but then you had the disruption in April. And in May, so far, no delivery whatsoever. There's no stock available. How's that one going to get resolved, do you think?
Well, again, tight supplies in any commodity, in any industry, ultimately become a price signal that does elicit a response. If people have trouble getting delivery, then people will start competing in price terms to get delivery somehow, some way. So as you say, rationing. When you start rationing something, what you're doing is a form of market manipulation. But people who are truly desperate will find a way around it, right? You'll get a black market or a gray market or whatever it is springing up around it, which does clear the market. This is Say's law. The market has to clear. People will find a way. And if it is true that the underlying physical demand is there and supplies are tight, well, ultimately that will get resolved through price in some form.
Yes, and we are, I think, beginning to see some premiums arising in places like India. Dubai, I think, is another one, and also China.
That's right. That's evidence of that, right?
Yeah. Looking at the sort of global economic scene, there was a very interesting thing which took us all by surprise, I think, last week, and that was a correspondent for the Wall Street Journal called, is it Hilsenrath?
John Hilsenrath, yeah.
That's the one, who appeared to leak something from the Fed to the extent that the Fed is now planning to slow down its monetization. Do you think there's anything behind that?
Well, look, you have to look at what Hilsenrath represents, I think, to understand this particular piece of reporting. Now, the Fed appear through the years, and this really started with Greenspan, but it's been continued by Bernanke. The Fed has used certain sources in the U.S. financial press as semi-official mouthpieces. So when it may be officially characterized as a leak because, of course, the Fed is not supposed to be whispering to a select group of people and giving them privileged information. But we know how government policymakers work on occasion. If they want to drop a hint, a strong hint, for the financial markets. You know, they do have these channels that they use to do it, and Hilsenrath is widely regarded to represent one of these semi-official channels. So it may officially be a leak in that sense, but really it is unofficial Fed speak. You can
right. So it's a sort of testing of the water.
Yes.
What's interesting in this is that I think in the last month or so, there's been some evidence of tax revenues in the States picking up a little bit, a bit of economic recovery. And then in this country, in the UK, we have signs that the economy is doing better than a lot of the naysayers expect. So could it be that the massive injections through quantitative easing of raw money into the economy in America, here, also Japan, presumably, is beginning to get some sort of economic recovery underway? Is this the beginning of another credit cycle, perhaps, which might, sort of start off with a boom and bust, or a half-hearted boom and an awful bust, or is it the sort of, if you like, the Keynesian hope that finally, economies are going to recover and rescue government from their awful financial position and banks from their insolvency?
Okay, Alasdair, I think what we need to do here first is to distinguish between leading, coincident, and lagging indicators. And depending on the leading indicator in question, you know, some of these tend to forecast activity just a few months out. Others tend to forecast activity, say, half a year out or even more. And I think it's only fair to say that there was a period last year when the leading indicators were looking pretty punchy. And now when you look at coincident indicators of activity, you know, they've looked a little bit better. And lagging indicators, of which the labor market is one, for example, also has looked, you know, a little bit better. So let's some of this has happened. You know, you already had some signs last year say that the stimulus was beginning to work its way through to some extent. And you know, but on the other hand, if you look at the leading indicators now, it looks like it's actually kind of come and gone. You've had a general downturn in leading indicators recently in the United States. Also in Europe, the leading indicators really haven't meaningfully recovered at all. The UK is kind of the exception to this, where in fact things are looking better, but then in relative terms, the UK has been an underperformer for a prolonged period of time. So maybe a little bit of relative recovery is only reasonable at this point. So that's kind of just a brief cyclical view of how I see where we currently are. You know, we did have a lot of stimulus. It does appear to have got a little bit of traction. But actually, if you step back and you look at this entire business cycle, which arguably began back in 2009, and you look at the overall pattern of the data that has occurred from 2009 to present, what you see is that real final demand, that is growth that is adjusted for the inventory cycle, and also you can look at real final demand, leaving the sort of imports and exports to the rest of the world out of it, focus on real final domestic demand, which should be the long-term core growth rate for an economy. If you look at that in the United States, it has never in this entire cycle got above 2%. Never. And that is a horrific performance across a business cycle. And yet, if that's the best we've been able to do, notwithstanding this heroic, if you want to call it that, monetary and fiscal stimulus, and yet now you actually are starting to see signs of a mature business cycle. You're seeing sort of late cycle indicators out there in the economy. It's actually relatively disturbing. What the big picture as I see it is the stimulus did have an effect. It did support growth. In particular, we got a bit of a little boomlet quite recently, but in fact, real final demand through this period overall has been terribly weak, suggests you've got a structurally very, very sick economy, and now you're getting into a late cycle stage where a proper downturn is more likely than a renewed upturn. And this is where I see a huge and growing disconnect between some of the asset price bubbles that are forming in the stock market, and even, believe it or not, in certain pockets of the U.S. property market. I was on the phone just yesterday evening with a good friend from the San Francisco Bay Area who used to work in real estate, and he is in stunned and shocked disbelief that notwithstanding the awful state of the California economy generally, the San Francisco Bay Area property market has nearly, in his opinion, recovered to not the peak of the housing bubble back in 2006, but has recovered to what he would say was kind of the, say, average price of the housing bubble all through the mid to 2000s. And he just can't believe it. He can't understand where it's coming from.
Well,
it's coming from the Fed.
It's coming from the Fed. Yes, I think that's right. There's another. There's little doubt in my mind that what you're saying is right, and that is that there has been this huge injection of money, and it's beginning to be reflected, if you like, in rising asset prices more than anything else. I'm wondering whether I may be taking things too far in the European context in tying this in with the unfortunate events in Cyprus a couple of months back. The subject I want to get to is the bail-ins, and I'm just wondering to what extent people are being discouraged from leaving money on deposit in banks as a result of that Cyprus episode, and whether instead that money is fueling this asset bubble even further. Do you think that's a new and developing factor, John?
Well, I share your concerns about bank deposits for certain. I think that Cyprus does set a precedent, whether policymakers choose to admit that or not. And in fact, there is a very important working policy paper which is publicly available, which is a joint paper published by the UK and the US regulatory authorities, which goes into actually quite a lot of detail regarding how a bail-in procedure would work in the event that a large UK or US financial institution with cross-border liabilities would fail. So this is being taken very seriously by policymakers, whether they choose to, again, discuss it publicly or not. So I share concerns in principle. Do I, however, believe that this Cyprus shock has reached into the general investing public? I don't think so. My sense is that people outside of Cyprus and outside of the weaker EU countries, EMU countries, do not see this as a reason to wind down their liquid bank deposit holdings and move into other types of assets and savings vehicles instead. I don't think that's the case. That said, it is something which can't be ruled out if we continue down this road. A Misesian, to use von Mises, an Austrian economist, a Misesian crack-up boom, which is the term he chose to characterize a situation in which faith and trust in the currency and the banking system is lost, and people simply rush to purchase anything else that could conceivably be a store of value. I don't think we're there yet, but we are on a road that could lead to a Misesian crack-up boom event where the stock market, the prices of automobiles, the prices of homes, the prices of anything that could conceivably hold its value when faith in the banking system is lost, that is something that could lie in our future.
Yeah, that's it. That's very interesting. I always think it's very difficult to draw a sort of a nice, neat line down and say, before this point, we weren't entering, if you like, the beginnings of a crack-up boom, and then after, we were definitely in that. I think life is not as easy as that. But I do take your point, and going back to the complacency, which I think is another word for what you were saying, the complacency of depositors. I was looking up some statistics on European banking deposits, and there is absolutely no evidence of money coming out of deposits. But what I'm wondering is, with all this extra money that is being produced by, in this case, through bank credit available from the ECB, I suppose what we're seeing is that money tending to go into assets rather than building up on bank deposits.
Yes, I think at the margin that's what's happening. But again, it could be happening more because people are misreading the economy and do believe against what we discussed earlier. Do believe that in fact this is a proper self-sustaining recovery, which is originating in the U.S. and will eventually spread around the world. Certainly, risk preferences do shift as people get additional faith and confidence that a recovery is self-sustaining, and people do want to get exposure to that, and so they move into the stock market or wherever else they can get that sort of exposure. So I think that's the more likely explanation for what's going on, not the Cyprus explanation. And again, the bank deposit movement data that you cite, I think, is evidence of that.
Yeah, no, that's interesting. So we have the gold price has been hit very, very hard. We have seen demand for the physical takeoff. At some stage, the premia are going to impact back on the paper market and get a bear squeeze going. I think that's a reasonable thought. The long-term economic outlook, while it's being talked up at the moment, and the idea that the Fed is now looking at some sort of exit from monetary expansion, which presumably suggests that they're confident that the medicine has worked and the future is all rosy. All that's a bit of a sideshow, really. So in terms of timing, I mean, do you see it very long before the global economy begins to sort of falter and perhaps the gold price starts moving up again? I mean, what sort of timescales would you have in mind?
Well, just quickly before I get to time scale, if the global economy falters in the initial stages, of course, the gold price could continue to decline. I mean, it will only recover when it becomes clear, and in time it probably will become clear that the policymakers will respond to faltering growth with yet another round of money printing, stimulus, and so on and so forth, which doesn't fundamentally solve anything, but it just does inject more liquidity.
Yeah, if I can just interject, that presumably would require a fall off in demand for physical bullion because I mean, in the short term, I think if I've got this right, the prices in the market are likely to be influenced more by that than the larger macroeconomic scene.
Yes. No, I agree with that. And this is where it's helpful to look at the broader commodities basket. And if you look at the broader commodities basket, what you see is that every segment of the commodities market has been in not just gentle, but actually relatively sharp decline over the last 6 months or so. And this is a real world physical telltale sign that growth is faltering and that the behavior of the stock market is increasingly at odds with what's really going on the ground. So you've had industrial metals prices falling, oil's holding up somewhat better because of instability in the Middle East, but it's off its highs. Grains prices are down. Prices for other agricultural commodities are down, and the basket as a whole has underperformed the stock market to a degree that has not been seen since 2007. And that's a very interesting year for comparison, if you ask me. That is, we know now in retrospect that the economic data in 2007 was overstating the amount of growth, and if the revisions that were subsequently made had the recession starting earlier and with a much steeper decline than was originally seen in the data. I think probably we're experiencing a similar sort of situation now. So it could well be that, in fact, some of the decline in the gold price we've already seen is simply reflective of this general economic weakness, which is increasingly in evidence for those who know what to look for, but which is not, as of yet anyway, capable of breaking this trend in the stock market. But again, that's what happened in 2007. The stock market was the last thing to go.
Absolutely. And I mean, so you would say that, you came up with a category of, whether indicators are leading or lagging or coincident. This would be a leading indicator to you, these commodity prices, would they?
I would say they're coincident. I would say they're more coincident. Now, it depends on which commodity you're looking at, because some commodities can be bought and then hoarded, and then, of course, are dishoarded, and it's all part of the inventory cycle. But the inventory cycle in general is coincident. It is generally regarded to be a coincident rather than a leading or lagging measure of economic activity. And so I would regard it as mostly coincident. So what it tells me is that the stock market is simply missing what is already an established deceleration of the global economy, and that this Fed speak that, oh, gee, actually things are beginning to look a bit better, is expectations management, and it is just PR. It's a public relations exercise, which is trying to maintain the Fed's credibility at a time when perhaps they feel they're going to need it again.
Well, I think that's very interesting. Well, John, I'd like to say thank you very much indeed for coming on. I think that might have clarified some of the current issues in our listeners' minds. And where can our listeners find you? What's the best internet site?
Well, probably where I maintain the archive and post the new issues of my Amphora Report newsletter, and that is a website, www.amphora-alpha.com, Amphora, AMPHORA-alpha.com, and then you can go to the report page there, and you can see what I'm writing about and what I've been writing about for the past few years. There's the entire archive.
John, thank you very much indeed.
Thank you, Alasdair. Always a pleasure.
Subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our Gold Research section.